On December 19th, 2025, the US Treasury released data. China's US Treasury holdings fell to $688.7 billion, the lowest level since 2008. Financial media classified this as routine portfolio adjustment. But the historical significance of this figure was overlooked. This is the exact mechanism that destroyed the British Empire. 1931, reserve currency collapse. Also September 1931, France made a simple request to Britain. We would like to convert our pounds to gold. 8 weeks later, the pound sterling, the world's reserve currency for 200 years, collapsed. Britain abandoned the gold standard. The empire began its terminal decline. China's $628 billion sell-off is not a transaction. It is a declaration. The countdown has already started. The reserve currency paradox. A reserve currency works on one principle: confidence. Countries hold your bonds because they believe you can always pay them back. But the trap built into the system: the more successful you become as a reserve currency, the more debt you must issue to supply the world with your currency. This is a mathematical paradox that eventually destroys every empire that achieves this status. By the end of 2025, the US has $38 trillion in debt. To service this massive obligation, we need foreign buyers: China, Japan, Saudi Arabia, to keep buying our bonds. We need them to believe the dollar is safer than anything else on earth. What happens when the rising power stops believing? In 1931, Britain owed massive debts from World War I. The economic cost of that conflict had hollowed out the empire's finances. France, now economically stronger after recovering from the war, decided to test British credibility. Prove you can pay, convert our pounds to gold. Britain couldn't do it. They didn't have enough gold in the vaults. On September 21st, 1931, they abandoned the gold standard. Translation: they defaulted. Not officially, because empires never admit default, but functionally, the pound sterling lost its credibility in a single day. Within 15 years, the dollar replaced the pound as the world's reserve currency. The British Empire, the largest in human history, began its irreversible collapse. What took 3 centuries to build unraveled in less than 20 years. 2025, the pattern repeats. Now look at 2025. China's treasury holdings have dropped from $1.3 trillion in 2013 to $688.7 billion today, $628 billion in reduction, a 47% collapse over 12 years. The critical detail: China didn't just reduce holdings gradually over time like a normal investor rebalancing a portfolio. According to data released by the US Treasury on December 19th, in October 2025, they dropped to 3rd place among foreign treasury holders, behind Japan and the UK. This is the first time since 2017 China hasn't been in the top 2 positions. What this means: the world's second largest economy, our biggest geopolitical rival, has systematically dismantled their position as our second largest creditor. This is not portfolio management. This is strategic positioning. Here's the parallel that should terrify anyone paying attention. While China dumps treasuries at an accelerating pace, they're stockpiling gold at a record rate that defies normal central bank behavior. Through September 2025, China bought gold for 11 consecutive months, bringing total reserves to 2,233 tons, according to official reports. Gold prices broke $4,000 per ounce in October 2025 for the first time in history. This is the 1931 playbook playing out in real time. France dumped pounds while buying gold. China is dumping treasuries while buying gold. The mechanism is identical: liquidate the existing reserve currency while simultaneously accumulating the crisis hedge that has held value for 5,000 years. Why now? The real question that should be keeping Treasury officials awake at night. Why now? Why did China accelerate these sales specifically in 2024 and 2025 after years of slower, more measured reductions? The answer reveals a debt trap tightening around the American financial system. 1931, the mathematics of collapse. On summer 1931, the Bank of England held 150 million pounds in gold reserves. To the British public and most of the world, this seemed impressive. But the problem French financial ministers had already calculated: foreign creditors held 400 million pounds in sterling deposits at British banks. The math didn't work. Simple division showed that if even half of those foreign creditors demanded conversion to gold, Britain would be completely drained. It was a bank run waiting to happen at the national level. France knew this. In July 1931, they started requesting gold conversions. Not all at once, in a way that would trigger immediate panic, but strategically, methodically, testing the system's breaking points. By September, the Bank of England had lost £200 million in gold in just 8 weeks. Picture the scene. Boats literally carrying gold bars from London to Paris, the physical transfer of wealth from a dying empire to a rising power. On September 21st, they capitulated. The gold standard was suspended. The pound fell 30% overnight against other currencies. The critical detail? France didn't do this randomly or out of spite. They did it because they saw Britain's fundamental debt trap with mathematical clarity. Post-World War I debts were crushing British finances despite all the victory propaganda. Debt service consumed 44% of government revenue by 1931. Nearly half of everything the British government collected in taxes went just to paying interest on old debts, not building new infrastructure, not investing in the future, just servicing the past. Britain couldn't grow out of the debt because the global economy was sliding into depression, couldn't inflate it away because the gold standard prevented printing money, couldn't service it honestly without destroying their economy through crushing taxation. When creditors called their bluff and demanded real payment in gold, it was over. 2025, the same trap. Fast forward to December 2025. The numbers should make every American deeply uncomfortable. The US debt-to-GDP ratio is 122.6%. According to data from the end of fiscal 2025, this is higher than Britain in 1931. We've crossed the threshold where debt becomes mathematically problematic even for the world's largest economy. U.S. interest payments in fiscal 2025 reached $970 billion. $970 billion just in interest payments. For the first time in American history, more than we spend on defense. The projection for 2026 crosses $1 trillion in annual interest costs. The trap tightening around the Federal Reserve and the Treasury Department. We can't raise rates without exploding debt service costs even further. Every half-point increase in rates adds roughly $100 billion to our annual interest bill. We can't cut rates too much without triggering inflation that destroys purchasing power and credibility. The Fed is trapped. Exactly like the Bank of England in 1931, caught between mathematical impossibilities. Throughout 2025, the Fed cut rates multiple times. Jerome Powell tried to signal confidence to markets, but what actually happened in the bond market, Treasury yields stayed high. The 10-year is at 4.14% in December 2025, despite the Fed's rate cuts. Translation: the market doesn't believe the Fed anymore. Bond traders are demanding higher yields to compensate for risk. They see what the Fed won't acknowledge publicly, just like creditors stopped believing the Bank of England's reassurances in 1931. China sees this with perfect clarity. That's why they slashed holdings to $688.7 billion. That's why their sales accelerated dramatically in 2024 and 2025 after years of slower reductions. They're not rebalancing a portfolio, they're exiting a burning building. Post-dollar infrastructure. The evidence confirming this isn't coincidence or normal financial management. In 2025, China's alternative to SWIFT, the mBridge payment system, became fully operational according to the Bank for International Settlements. This system allows countries to settle international trade without using dollars. The plumbing for a post-dollar world is already installed and functioning. BRICS nations expanded in 2024. Saudi Arabia, UAE, Egypt, Ethiopia, and Iran were added to the original Brazil, Russia, India, China, South Africa core. 45% of global population now operating with reduced dollar dependency and exploring alternative settlement systems. Gold purchases tell the real story central banks are preparing for. According to World Gold Council data, central banks globally bought 1,037 tons of gold in 2023, the highest level since 1967. China bought gold for 11 straight months through September 2025, reaching 2,233 tons in official reserves. Gold broke $4,000 per ounce in October 2025, a historic milestone signaling institutional money fleeing to safety en masse. This is the 1931 pattern on steroids, accelerated by modern technology and global coordination. Dump the reserve currency, build alternative systems, stockpile gold. France did it alone in 1931. China is doing it with half the world's population economically aligned. The acceleration timeline. What should really grab attention? The acceleration timeline. China held over $1 trillion in treasuries as recently as 2016. They've dumped nearly $400 billion in less than a decade, with the pace increasing each year. In 2013, they peaked at $1.317 trillion. By 2020, they were below $1.1 trillion. By 2023, below $900 billion. October 2025, $688.7 billion. This is not gradual portfolio adjustment. This is systematic liquidation following a predetermined strategy. The question everyone should be asking: when does this selling reach the breaking point? When does it accelerate so much that treasury auctions start failing, yields spike uncontrollably, the system begins its terminal cascade? There is a mathematical threshold, the point where there aren't enough buyers to absorb US debt issuance at stable yields. China currently holds $688.7 billion in US Treasuries as of October 2025. Since the 2013 peak of $1.317 trillion, they've reduced holdings by $628 billion. A 47% collapse over 12 years. The critical threshold bond traders understand, but is rarely discussed publicly. Market liquidity breaks down when major holders drop below $500 billion. Below that level, there simply aren't enough stable, predictable buyers to absorb U.S. debt issuance without yields spiking dramatically to attract marginal buyers. At current reduction rates, averaging 50 to 60 billion per year in recent years, with clear acceleration in 2024 and 2025, China hits $500 billion by late 2026 or early 2027. The reality that makes the timeline even more compressed: the U.S. must refinance $9.2 trillion in debt by December 2025, according to Congressional Budget Office projections. This is maturing debt that must be rolled over, new bonds that must be sold to pay off old bonds. Who's going to buy it? Japan is the largest holder at $1.15 trillion peak. The UK is second at roughly $900 billion. China is third at $688.7 billion and falling every month. These three countries alone represent a massive portion of foreign treasury demand, and two of them are reducing holdings. The debt service crisis. The Congressional Budget Office projects interest payments will exceed $1 trillion in 2026. We're already at $970 billion in fiscal 2025. Just 5 years ago, interest payments were under $400 billion annually. The problem, creating an impossible situation for the Treasury Department: every 0.5% increase in Treasury yields adds $100 billion in annual interest costs when we refinance our debt. The 10-year yield is at 4.14% right now in December 2025. If it hits 5%, entirely likely if major holders keep selling and demand weakens, we add $200 billion in annual debt service from $970 billion to $1.17 trillion. That's approaching 20% of federal revenue going just to interest payments. This is the Britain 1931 threshold where the math stops working. Four-stage collapse model collapses don't happen gradually. They happen in distinct stages that accelerate dramatically. Stage 1, the slow burn, 2013 to 2023. China reduces treasury holdings from $1.3 trillion to $800 billion over a decade. Markets ignore it as normal central bank operations. Stage 2, the acceleration, 2024 to 2025. Sales intensify dramatically. $800 billion drops to $688.7 billion in under 2 years. China falls to third place among foreign holders for the first time since 2017. Stage 3, the liquidity crisis, projected for 2026. We're heading here based on current trajectories. Multiple major holders selling simultaneously, not just China. Treasury auctions start failing to clear at expected yields. The Fed faces the nightmare choice: let yields spike or print money to buy the debt themselves. Stage 4, the capitulation, projected late 2026 to 2027. Fed announces temporary quantitative easing despite inflation concerns. Dollar plunges against gold and hard assets. Reserve currency status begins terminal decline. Alternative systems like mBridge see explosive adoption. Britain went from stage 2 to stage 4 in 8 weeks during summer 1931, from concerning to catastrophic in 8 weeks. We entered stage 2 in 2024 to 2025 when China dropped below $700 billion and sales accelerated noticeably. If the timeline mirrors 1931's velocity, stage 4 could hit between mid-2026 and early 2027. 5 critical triggers. Trigger 1, China drops below $600 billion, projected for Q2 to Q3 to 2026. This marks accelerated liquidation beyond normal portfolio management. Trigger 2, Treasury auction failures, projected for late on 2026. This is when the US tries to auction bonds and yields spike unexpectedly high to attract buyers. Watch for 10-year yields above 5% sustained. Trigger 3, Fed emergency measures, projected for 2026 to 2027 timeframe. This is when the Fed announces temporary bond purchases despite inflation concerns. This is the Weimar moment, printing money to buy your own debt because no one else will at reasonable rates. Trigger 4, gold breaks $5,000 per ounce sustainably. Current price is above $4,000 as of October 2025. Goldman Sachs projects $4,900 by December 2026. When gold breaks $5,000 and holds above it for weeks, institutional money is fleeing to safety en masse. Trigger 5, interest payments exceed $1.2 trillion, projected for 2027. We're at $970 billion in fiscal 2025. CBO projects over $1 trillion in 2026. If we hit $1.2 trillion, that's 20% plus of revenue to interest alone. Political vulnerability. Timeline concentration makes this even more dangerous. Political transitions create maximum vulnerability in any system. If this crisis hits during election uncertainty or presidential transition periods in 2026 to 2027, there's weakened institutional capacity to respond coherently. This is the Britain scenario exactly. Political chaos plus financial crisis equals systemic collapse. Britain had a minority government in 1931. When the crisis hit, they couldn't mount a coordinated response fast enough. Conclusion: what you're actually watching unfold in real time. China isn't selling down to $688.7 billion in treasuries because they need cash for domestic purposes. China has $3.2 trillion in total reserves. They're not desperate for dollars. They're selling because they see the same thing France saw in 1931 with mathematical certainty: a debt-trapped empire that can't grow out of its obligations. The math doesn't work. China knows it. Russia knows it. BRICS nations know it. That's why they're building alternative systems. The only question is, when does the selling accelerate from $50 billion a year to $100 billion to $200 billion in a single quarter? That's when stage 3 becomes stage 4. Britain had 8 weeks from acceleration to collapse in 1931. We're in the acceleration phase now. By this math, by this historical pattern, late 2026 through 2027 is when you'll know whether the dollar survives as the world's reserve currency, or if we're watching the beginning of the end of American financial dominance. The same move that destroyed Britain in 1931 is playing out right now. The same mechanism, the same stages, the same mathematical inevitability. At Falling Value, we continue to analyze reserve currency dynamics, debt sustainability, and geopolitical financial maneuvering. We bring you structural changes that financial media ignores but will affect the global order. Don't forget to subscribe and turn on notifications.